Welcome to the complete series recap for the ASC 718 SBC training course from PNJ Group. This video is your fast-track review of everything covered across the 6 sections, from the foundational concepts through the operational execution checklist. Whether you are reinforcing what you learned, preparing for a review, or returning after some time away from this material, this recap covers the full arc of a SC 718 accounting in a single consolidated session. The entire SC 718 framework rests on a single foundational principle. Stock-based compensation is a real cost of doing business. When a company grants options or RSUs, it transfers genuine economic value, an ownership stake, to employees. That transfer must be measured at the grant date and recognized systematically over the period the employee earns the award. SBC touches all 3 financial statements simultaneously. It reduces operating income on the income statement, it builds up a PIC on the balance sheet, and it appears as a non-cash add-back in operating activities on the cash flow statement. A SC 718 is deliberately broad. If an award is tied to the entity's equity in any way, it almost certainly falls within scope. The 5 main award types each deliver value differently. Stock options give employees the right to buy shares at a fixed exercise price, value only if the stock rises. RSUs deliver free shares upon vesting, value is immediate and predictable. Restricted stock is issued at grant but subject to forfeiture. PSUs add a performance or market condition gate on top of the RSU structure. And cash-settled SARs pay cash equal to stock price appreciation, avoiding share dilution but creating liability classification. Each award type has a specific fair value measurement approach. Black-Scholes for options, the stock price for RSUs and restricted stock, the stock price adjusted for probability for PSUs with non-market conditions, and Monte Carlo simulation for TSR-based PSUs. The equity versus liability classification decision is the most consequential technical choice in a SC 718. Equity classified awards are measured once at grant date fair value, and that amount never changes. Liability classified awards are remeasured at every reporting date, creating ongoing income statement volatility that tracks the stock price. The classification test comes down to one question: who controls settlement form? Equity requires the fixed for fixed test, a fixed number of shares for a fixed price. Any variability in either dimension, or any right for the employee to demand cash, creates liability classification. The Black-Scholes-Merton model requires 6 inputs: stock price, exercise price, expected term, expected volatility, risk-free rate, and expected dividends. Expected volatility is the most sensitive. A 10 percentage point change can shift option fair value by 15 to 25%. For public companies, historical volatility over a period matching the expected term is the standard approach. For private companies, peer company volatility is required since no price history exists, and that peer group selection is a critical audited judgment. Higher volatility, longer expected term, and higher stock price all increase option fair value. Higher exercise price and higher expected dividends reduce it. The 3 vesting condition types each follow different accounting rules, and confusing them is one of the most common errors in practice. Service conditions are straightforward, straight-line expense over the vesting period, reversed if the employee leaves. Performance conditions adjust the number of expected awards each period based on an updated probability estimate. If the target ultimately fails, all previously recognized expense is reversed. Market conditions are the most counterintuitive. The probability is embedded in the grant date fair value through Monte Carlo. Even if the TSR target is completely missed, the company still recognizes the full SBC expense over the service period. The only reversal trigger is an employee forfeiture, not a market target miss. 3 expense recognition rules deserve special emphasis because they are the most frequently missed. First, retirement-eligible employees require expense acceleration. The full grant must be recognized by the date the employee is eligible to retire, not over the full vesting period. Check every new grant and every existing grantee for this. Second, performance condition updates use a cumulative catch-up. At the end of each period, calculate what cumulative expense should have been recognized to date at the current probability estimate and true up in the current period. Third, when an award is forfeited or canceled, reverse the cumulative expense immediately. No continued amortization. No spreading the reversal over the remaining would-be vesting period. A modification is any change to an existing award's terms. The incremental value model measures the additional cost, fair value of the modified award minus fair value of the original award, both measured on the modification date. This incremental amount is recognized over the shorter of the remaining or new vesting period. The original expense continues. If an award is canceled and immediately replaced, treat it as a modification. If canceled with no replacement, any unrecognized expense must be recognized at once. These rules apply equally to repricing, performance target relaxation, vesting acceleration on termination, and any other change to the award terms. In the money, options and unvested RSUs are dilutive securities that reduce diluted EPS. The Treasury stock method calculates the net dilutive effect for options. Assume exercise, generate proceeds, repurchase shares at the average market price, net the difference. RSUs are simply fully dilutive. No exercise price means no buyback, so every RSU share counts. On the tax side, book SBC expense creates a deferred tax asset over the vesting period. When awards vest or are exercised, the DTA reverses and the company compares the actual tax deduction to the cumulative book expense. Under a SU 2016-09, both excess tax benefits and shortfalls run through income tax expense, impacting the effective tax rate in the period of vest. The journal entry framework is clean. Every quarter, the core SBC expense entry debits compensation expense by function and credits a PICSBC for the proportionate grant date fair value earned. When options are exercised, cash and a PICSBC are debited together and reclassified into common stock and regular a PIC, the equity accounts. When RSUs vest, a PICSBC is debited and the shares are credited to common stock accounts, no cash, just a reclassification. When a forfeiture occurs, a PICSBC is debited and compensation expense is credited, reducing expense in the reversal period. Vesting and exercise events are equity reclassifications, not new expense events. Expense was already recognized over the vesting period. A SC 718 requires one of the most extensive disclosure packages in U.S. GAAP. Investors rely on these disclosures to understand the future SBC expense burn. The unrecognized compensation cost schedule is particularly important for financial modeling. The disclosure package includes a description of all SBC plans and award types, the full option roll forward, total SBC expense by income statement line with the related tax benefit, total unrecognized cost and when it will be recognized, the intrinsic value of awards exercised and vested during the period, and the Black-Scholes assumptions for each grant, expected volatility, term, risk-free rate, and dividends. Preparing these disclosures requires the same schedules that auditors request, so keeping them current at each period end produces both clean financials and audit-ready documentation. The 7 common mistakes from Section 6 are worth anchoring in memory. Treating SBC as zero cost, wrong. It is a real expense. Continuing to amortize after a forfeiture, wrong. Reverse immediately. Not accelerating for retirement-eligible employees, a frequent underaccrual. Using intrinsic value instead of Black-Scholes at the money options are not zero expense. Applying the IFRS forfeiture estimation method in a U.S. GAAP engagement without checking the policy election. Not recognizing expense for market condition awards that miss their targets, the expense stands, and presenting SBC as a separate income statement line without policy support. Each of these has happened in real engagements, and each has a specific prevention step. Audit readiness is built at each grant date and each period end, not assembled after the audit request letter arrives. The documentation package covers 4 areas: award documentation, valuation documentation, roll-forward schedules, and tax work. Award documentation means the actual plan documents, grant agreements, and board resolutions that establish the existence and terms of each award. Valuation documentation means the BSM or Monte Carlo model for each grant with every input tied to an external source. Roll-forward schedules must reconcile beginning balance to ending balance for both awards and expense, and those schedules must tie to the cap table and general ledger. Tax documentation requires a DTA roll-forward and the excess benefit or shortfall calculation for each vesting event during the period. IFRS 2 and a SC 718 share the same core principle and are broadly converged. The two practical differences that arise most often in real engagements are forfeitures and tax accounting. On forfeitures, U.S. GAAP allows entities to choose between estimating expected forfeitures or recognizing them as they actually occur. IFRS 2 requires estimation only. Companies with high turnover in markets where both standards apply will show different early period SBC expense patterns. On tax accounting, U.S. GAAP under a SU 2016-09 routes all excess benefits and shortfalls through income tax expense. IFRS 2 routes the expected tax benefit through equity, with only the excess going through profit and loss. This creates comparability differences in reported effective tax rates between U.S. GAAP and IFRS reporters. 6 sections, 1 framework. Stock-based compensation is a real cost that must be measured at the grant date and recognized over the period of service. Classification as equity or liability is the most consequential decision. Equity awards are stable and predictable. Liability awards create ongoing remeasurement risk. The vesting condition type, service, performance, or market determines the expense pattern, and critically, whether a missed target triggers a reversal or not. Market conditions never reverse. Performance conditions always do if the target fails. Operational excellence in SBC accounting means reconciling HR data every period, checking retirement eligibility on every new grant, documenting every valuation and estimate contemporaneously, and applying the 3-level review structure so that judgment calls receive appropriate oversight. Thank you for completing the ASC 718 SBC Complete Training Series from PNJ Group. Thank you for watching. Subscribe for more training from PNJ Group.